Question 1. Topic: Policy riders and options. A client purchases a term life insurance policy with a guaranteed insurability rider. Which of the following options best explains how this rider affects the policyholder's future options? A. The policyholder can renew the policy without providing evidence of insurability but must accept higher premiums based on their current age. B. The policyholder can increase the coverage amount at specified ages or life events without providing evidence of insurability. C. The policyholder can convert the term policy to a whole life policy at any time without an increase in premiums. D. The policyholder can reduce their coverage amount at any time without providing evidence of insurability. Answer: B. The policyholder can increase the coverage amount at specified ages or life events without providing evidence of insurability. Explanation: a guaranteed insurability rider allows the policyholder to purchase additional insurance coverage at specific times, such as certain ages or life events like marriage or the birth of a child, without undergoing a medical exam or providing evidence of insurability. This option is crucial for policyholders who anticipate needing more coverage in the future but might face health changes that can make getting more insurance difficult. A describes the renewability feature, not guaranteed insurability. C refers to the conversion feature, which allows term policies to be converted to whole life but doesn't relate to guaranteed insurability. D is incorrect because reducing coverage generally doesn't require evidence of insurability but isn't related to this rider. Question 2. Scenario-based. Topic: Beneficiary designations. Mr. Davis, a 45-year-old policyholder, designates his spouse as the primary beneficiary and his 2 children as contingent beneficiaries in his term life insurance policy. Unfortunately, Mr. Davis and his spouse pass away in a car accident, leaving his children behind. His term life insurance has a death benefit of $500,000. What will happen to the death benefit in this situation? A. The death benefit will be divided equally between Mr. Davis's children since they are the contingent beneficiaries. B. The death benefit will be paid to Mr. Davis's estate because both the primary and contingent beneficiaries have passed away. C. The death benefit will be paid to Mr. Davis's children but reduced by probate costs. D. The death benefit will remain unclaimed since the primary beneficiary has passed away. Answer: A. The death benefit will be divided equally between Mr. Davis's children since they are the contingent beneficiaries. Explanation: when both the policyholder and the primary beneficiary die, the contingent beneficiaries receive the death benefit. In this case, Mr. Davis's children are the contingent beneficiaries and will share the death benefit equally as per the terms of the policy. B is incorrect because the contingent beneficiaries are alive, so the estate does not come into play. C is incorrect because life insurance death benefits are typically paid directly to beneficiaries and do not go through probate unless no beneficiaries are designated or alive. D is incorrect because contingent beneficiaries exist and will receive the death benefit. Question 3. Topic: Mississippi insurance laws. Policy replacement. When replacing a term life insurance policy in Mississippi, which of the following actions is the insurance agent required to take? A. The agent must notify the Mississippi Department of Insurance of the replacement and provide a justification for why the new policy is in the client's best interest. B. The agent must provide the policyholder with a notice regarding replacement outlining the potential disadvantages of replacing the policy. C. The agent is not required to inform the policyholder about any potential disadvantages as long as the new policy offers more coverage. D. The agent must cancel the old policy before issuing the new policy to avoid dual coverage issues. Answer: B. The agent must provide the policyholder with a notice regarding replacement outlining the potential disadvantages of replacing the policy. Explanation: under Mississippi's replacement rules, an insurance agent is required to provide the policyholder with a notice regarding replacement that explains the potential downsides of replacing a policy, such as losing certain benefits or coverage features. This ensures that the policyholder is making an informed decision. A is incorrect as notifying the Department of Insurance is not a requirement for individual policy replacements. C is incorrect because the agent must always inform the policyholder of both the advantages and disadvantages of replacement. D is incorrect because the old policy is typically not cancelled until the new policy is enforced to avoid a coverage gap. Question 4. Topic: Premium structures and payment modes. Which of the following best describes how the premium structure of a level term life insurance policy operates? A. The premium stays the same throughout the entire term and the death benefit decreases as the policyholder ages. B. The premium increases each year, but the death benefit stays level throughout the term of the policy. C. The premium remains the same throughout the entire term and the death benefit also remains level. D. The premium decreases each year as the policyholder gets older and the death benefit stays the same. Answer: C. The premium remains the same throughout the entire term and the death benefit also remains level. Explanation: in a level term life insurance policy, both the premium and the death benefit remain constant for the entire duration of the term. This makes it an attractive option for policyholders seeking stable and predictable costs while maintaining consistent coverage. A is incorrect because in a level term policy, the death benefit does not decrease. B is incorrect because the premium remains the same throughout the term, not increasing. D is incorrect because the premium does not decrease over time in level term policies. Question 5. Scenario-based. Topic: claims and benefits. Mrs. Carter purchased a 20-year term life insurance policy and passed away after 18 years. Her beneficiary, her son, files a claim. The insurer discovers that Mrs. Carter understated her age by 2 years on the policy application. What will the insurer most likely do? A. Deny the claim entirely because of the misstatement of age. B. Pay the full death benefit because the misstatement is irrelevant after the policy is issued. C. Adjust the death benefit to what Mrs. Carter's premiums would have purchased if her correct age had been stated. D. Refuse to pay the claim and refund the premiums paid due to misrepresentation. Answer: C. Adjust the death benefit to what Mrs. Carter's premiums would have purchased if her correct age had been stated. Explanation: according to the misstatement of age provision, if an insured person misstates their age on the policy, the insurer will adjust the death benefit based on the correct age and the premiums that were actually paid. This provision allows insurers to correct for discrepancies without voiding the policy entirely. A is incorrect because the claim is not denied but adjusted. B is incorrect because age is a material fact and misstatements affect the policy. D is incorrect because this does not constitute misrepresentation serious enough to void the policy entirely. Question 6. Topic: conversion rights to permanent insurance. Under convertible term life insurance policy, which of the following describes the process of converting to a permanent policy? A. The policyholder can convert the term policy to a permanent policy at any time and the premiums will remain the same as the term policy. B. The policyholder can convert the policy, but the premiums for the permanent policy will be based on the age when the term policy was first purchased. C. The policyholder can convert the policy without providing evidence of insurability, but the premiums for the permanent policy will be based on the age at the time of conversion. D. The policyholder must provide proof of insurability when converting to a permanent policy, and the premiums will be based on the original term policy premiums. Answer: C. The policyholder can convert the policy without providing evidence of insurability, but the premiums for the permanent policy will be based on the age at the time of conversion. Explanation: most convertible term life insurance policies allow the policyholder to convert that term policy to a permanent policy without providing evidence of insurability. However, the new premiums are generally calculated based on the policyholder's age at the time of conversion, which often results in higher premiums than the original term policy. A is incorrect because premiums will change when converting to a permanent policy. B is incorrect because premiums are based on the age at conversion, not the age when the term policy was first purchased. D is incorrect because no insurability evidence is needed for conversion. Question 7. Topic: incontestability clause. What is the purpose of the incontestability clause in a term life insurance policy? A. It allows the insurance company to deny any claim during the first 2 years for any reason. B. It prevents the insurance company from contesting claims after the policy has been in force for a specified period, typically 2 years, except for cases of fraud. C. It guarantees that the insurance company will pay all claims as long as premiums have been paid, regardless of any misrepresentation on the application. D. It allows the policyholder to contest the terms of the policy within 2 years of purchasing it. Answer: B. It prevents the insurance company from contesting claims after the policy has been in force for a specified period, typically 2 years, except for cases of fraud. Explanation: the incontestability clause ensures that after a term life insurance policy has been in effect for a certain period, usually 2 years, the insurer cannot contest or deny claims based on misrepresentations or errors made in the application except in cases of proven fraud. This clause protects policyholders and beneficiaries from having claims denied for minor or unintentional mistakes. A is incorrect because claims cannot be denied for any reason within 2 years. There must be valid grounds. C is incorrect because claims can be denied within the contestability period for certain reasons. D is incorrect because the clause protects policyholders from the insurer contesting claims, not the other way around. Question 8. Topic: Grace period and lapse. In Mississippi, if a policyholder fails to pay the premium by the due date, what happens during the grace period of a term life insurance policy? A. The policy lapses immediately and coverage is terminated. B. The policy remains active, but the insurance company reduces the death benefit during the grace period. C. The policy remains active and the policyholder has additional time to pay the overdue premium, usually 31 days. D. The policy is suspended until the premium is paid and coverage resumes after payment. Answer: C. The policy remains active and the policyholder has additional time to pay the overdue premium, usually 31 days. Explanation: in Mississippi, as in most states, the grace period for term life insurance is typically 31 days. During this period, the policy remains in force and the policyholder has the opportunity to make the overdue premium payment to avoid a lapse in coverage. If the policyholder dies during the grace period, the death benefit is still paid, though the overdue premium may be deducted from the payout. A is incorrect because the policy does not lapse immediately after missing a payment. B is incorrect because the death benefit is not reduced during the grace period. D is incorrect because the policy is not suspended but remains active. Question 9. Topic: Policyholder protections. Mississippi Life and Health Insurance Guarantee Association. Which of the following protections does the Mississippi Life and Health Insurance Guarantee Association provide for policyholders? A. It guarantees payment of all claims regardless of the insurance company's financial situation. B. It protects policyholders by guaranteeing coverage up to specified limits if the insurer becomes insolvent. C. It reimburses policyholders for any premium payments made to insolvent insurers, regardless of coverage status. D. It takes over the management of policies from insolvent insurers and issues new policies at low rates. Answer: B. It protects policyholders by guaranteeing coverage up to specified limits if the insurer becomes insolvent. Explanation: the Mississippi Life and Health Insurance Guarantee Association provides protection to policyholders by ensuring that coverage is maintained up to certain statutory limits if an insurance company becomes insolvent. This ensures that policyholders are not left without coverage in case their insurer fails. Although the protection is not unlimited, A is incorrect because there are specified limits to the protection. C is incorrect because the association doesn't reimburse policyholders for premium payments but ensures coverage up to limits. D is incorrect because the association does not issue new policies but guarantees the existing coverage. Question 10. Topic: Reinstatement of lapsed policy. Which of the following is generally required to reinstate a lapsed term life insurance policy? A. Payment of all missed premiums with interest and evidence of insurability. B. A written request from the policyholder without the need for any payment of missed premiums. C. Only the payment of the next premium with no further requirements. D. The policyholder must purchase a new policy as reinstatement is not allowed. Answer: A. Payment of all missed premiums with interest and evidence of insurability. Explanation: to reinstate a lapsed policy, most insurers require the payment of all overdue premiums, often with interest, and proof that the insured is still in good health, evidence of insurability. This protects the insurer from having to cover policyholders who have developed new health conditions since the policy lapsed. B is incorrect because paying missed premiums is required. C is incorrect because all missed premiums must be paid, not just the next one. D is incorrect because reinstatement is usually allowed within a certain period. Question 11. Topic: Exclusions in life insurance policies. Which of the following situations would most likely result in the denial of a life insurance claim? A. The policyholder dies from a heart attack 2 years after the policy was issued. B. The policyholder dies while serving in the military in a combat zone. C. The policyholder dies in an accident 6 months after purchasing the policy. D. The policyholder dies from cancer, which was diagnosed after the policy was issued. Answer: B. The policyholder dies while serving in the military in a combat zone. Explanation: many life insurance policies contain exclusions for high-risk activities such as military service in combat zones. In such cases, the insurer may deny the claim if the death occurred during military service unless additional coverage was purchased. A and D are incorrect because natural causes after the contestability period usually do not lead to claim denial. C is incorrect because accidental death is generally covered, especially after the policy is issued. Question 12. Topic: Waiver of premium. In which situation would the waiver of premium rider be triggered for a life insurance policyholder? A. The policyholder becomes unemployed and cannot afford the premiums. B. The policyholder becomes disabled and cannot work. C. The policyholder is diagnosed with a terminal illness but is still able to work. D. The policyholder temporarily moves out of the country for work and stops paying premiums. Answer: B. The policyholder becomes disabled and cannot work. Explanation: the waiver of premium rider allows the policyholder to stop paying premiums if they become totally disabled and are unable to work. As long as the rider was purchased with the policy, the coverage remains active without requiring premium payments. A is incorrect because unemployment is not typically covered by the waiver of premium rider. C is incorrect because the rider is triggered by disability, not just illness. D is incorrect because moving abroad does not trigger the rider. Question 13, topic: ownership of life insurance policy. Which of the following is true regarding the ownership of a life insurance policy? A. The insured must always be the policyholder. B. The policyholder and the insured must always be the same person. C. The policyholder has the right to assign the policy to someone else. D. The beneficiary automatically becomes the owner of the policy upon the death of the insured. Correct answer: C. The policyholder has the right to assign the policy to someone else. Explanation: the policyholder, owner of the policy, has the right to assign the policy to another person or entity such as a trust or another individual. The policyholder is the one who pays premiums and controls the policy. The insured can be a different person than the policyholder. A and B are incorrect because the policyholder does not have to be the insured. D is incorrect because the beneficiary receives the death benefit, not ownership of the policy. Question 14, topic: beneficiaries. A life insurance policy lists two primary beneficiaries. One beneficiary is to receive 60% of the death benefit and the other is to receive 40%. If the first beneficiary dies before the insured, what happens to the death benefit? A. The second beneficiary receives the entire death benefit. B. The first beneficiary's share is given to the second beneficiary's estate. C. The entire death benefit is paid to the insured's estate. D. The policyholder must update the beneficiaries before the death benefit can be paid. Answer: A. The second beneficiary receives the entire death benefit. Explanation: when a primary beneficiary dies before the insured, the remaining primary beneficiary will typically receive the entire death benefit unless the policy states otherwise, such as contingent beneficiaries being named. B and C are incorrect because the death benefit does not go to the deceased beneficiary's estate. D is incorrect because the policy does not require updates for payout. Question 15, topic: accidental death benefit rider. What additional coverage does the accidental death benefit rider provide in a life insurance policy? A. It pays double or triple the face amount if the insured dies from an accident. B. It increases the death benefit if the insured dies of natural causes. C. It covers the insured for a longer term without increasing premiums. D. It eliminates the contestability period for accidental deaths. Answer: A. It pays double or triple the face amount if the insured dies from an accident. Explanation: the accidental death benefit rider, also known as double indemnity, typically provides an additional payout, often double or triple the policy's face value if the insured dies due to an accident. B is incorrect because the rider applies to accidental deaths, not natural causes. C is incorrect because the rider does not extend the term of coverage. D is incorrect because the contestability period still applies. Question 16, topic: policy loans. Which of the following is true regarding policy loans on whole life insurance policies? A. The policyholder must repay the loan within 5 years or the policy lapses. B. The loan is tax-free, but the interest on the loan accrues and must be paid. C. The loan is automatically forgiven if the policyholder dies before repayment. D. The loan is taxable as income when taken from the policy's cash value. Answer: B. The loan is tax-free, but the interest on the loan accrues and must be paid. Explanation: policy loans taken against the cash value of a whole life insurance policy are typically tax-free, but they accrue interest that must be paid if the loan is not repaid. The amount owed, loan plus interest, will reduce the death benefit when the insured dies. A is incorrect because there is no strict repayment term. C is incorrect because the loan is not forgiven but deducted from the death benefit. D is incorrect because policy loans are generally not taxed as income. Question 17, topic: grace period. During the grace period for life insurance premium payments, what happens to the policy's coverage? A. Coverage is suspended until payment is made. B. Coverage remains in force, but the death benefit is reduced. C. Coverage remains in force for the full death benefit amount. D. Coverage is automatically cancelled if the premium is not paid on time. Answer: C. Coverage remains in force for the full death benefit amount. Explanation: during the grace period, which is usually 3031 days after the premium due date, the policy remains in full force, meaning the death benefit will still be paid if the insured dies during this period. However, if the premium is not paid by the end of the grace period, the policy may lapse. A is incorrect because coverage is not suspended during the grace period. B and D are incorrect because coverage continues for the full death benefit amount until the grace period expires. Question 18. Topic: misstatement of age or gender. If an insured's age is misstated on a life insurance application, how does the insurer handle the claim? A. The insurer cancels the policy and refunds the premiums. B. The insurer adjusts the death benefit to reflect the correct age and the premiums paid. C. The insurer denies the claim entirely. D. The insurer charges the policyholder additional premiums retroactively. Answer: B. The insurer adjusts the death benefit to reflect the correct age and the premiums paid. Explanation: if a misstatement of age or gender is discovered, most insurers will adjust the death benefit to reflect the amount that would have been purchased with the correct age or gender and the premiums that were actually paid. This ensures fairness to both the insurer and the policyholder. A and C are incorrect because the policy is not cancelled or denied unless fraud is involved. D is incorrect because additional premiums are not typically charged retroactively. Question 19. Topic: suicide clause. If the insured commits suicide within the first 2 years of the policy being in force, what typically happens to the life insurance death benefit? A. The insurer pays the full death benefit to the beneficiaries. B. The insurer refunds the premiums paid, but no death benefit is paid. C. The insurer pays a reduced death benefit based on a percentage of the premiums paid. D. The insurer denies the claim and keeps all premiums paid. Answer: B. The insurer refunds the premiums paid, but no death benefit is paid. Explanation: most life insurance policies have a suicide clause that states if the insured commits suicide within a certain period, typically 2 years, the insurer will not pay the death benefit but will refund the premiums paid. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide shortly after. A is incorrect because the full death benefit is not paid during the suicide exclusion period. C is incorrect because policies generally refund the premiums without paying a reduced benefit. D is incorrect because the insurer refunds the premiums, not retains them. Question 20. Topic: contestability period. What is the primary purpose of the contestability period in a life insurance policy? A. To allow the insurer to refuse payment if the policyholder dies from a high-risk activity. B. To give the insurer time to investigate and potentially deny claims based on misrepresentations made in the application. C. To delay payment of the death benefit until all premium payments have been verified. D. To provide a period during which the insured can change beneficiaries without penalty. Answer: B. To give the insurer time to investigate and potentially deny claims based on misrepresentations made in the application. Explanation: the contestability period, typically lasting 2 years from the policy's issue date, allows the insurer to investigate claims and deny coverage if they discover material misrepresentations, such as health conditions, in the application. After this period, the insurer cannot contest the policy except in cases of fraud. A is incorrect because the contestability period is not related to high-risk activities. C is incorrect because the period does not relate to verifying premium payments. D is incorrect because the contestability period does not affect beneficiary changes. Question 21. Topic: whole life insurance. Which of the following is a feature of a whole life insurance policy? A. It offers a cash value component that grows tax-free. B. It provides temporary coverage that expires at a certain age. C. It is designed to provide lower premiums as the insured ages. D. It does not offer any loan provisions for the policyholder. Answer: A. It offers a cash value component that grows tax-free. Explanation: whole life insurance offers permanent coverage for the insured's entire life and includes a cash value component that grows on a tax-deferred basis. Policyholders can access this cash value via loans or withdrawals during their lifetime. B is incorrect because whole life insurance provides lifetime coverage, not temporary. C is incorrect because whole life premiums generally remain fixed. D is incorrect because policyholders can take loans against the cash value. Question 22. Topic: variable life insurance. In a variable life insurance policy, the cash value is invested in A. A fixed interest account controlled by the insurer. B. Investment accounts chosen by the policyholder, which may include stocks, bonds, or mutual funds. C. Real estate owned by the insurer. D. Precious metals like gold or silver. Answer: B. Investment accounts chosen by the policyholder, which may include stocks, bonds, or mutual funds. Explanation: variable life insurance allows policyholders to invest the policy's cash value in various investment accounts, such as stocks, bonds, or mutual funds. The policyholder assumes the investment risk, and the cash value fluctuates based on the performance of these investments. A is incorrect because variable life insurance involves investment options, not fixed accounts. C and D are incorrect because the policyholder typically cannot invest directly in real estate or precious metals through variable life policies. Question 23. Topic: Term life insurance. Which statement is true regarding term life insurance? A. It accumulates cash value that can be borrowed against. B. It provides permanent coverage that lasts for the insured's lifetime. C. It offers a death benefit if the insured dies during the term, but does not build cash value. D. It has higher premiums than whole life insurance for the same coverage amount. Answer: C. It offers a death benefit if the insured dies during the term, but does not build cash value. Explanation: term life insurance provides coverage for a specified term, e.g. 10, 20, 30 years, and only pays a death benefit if the insured dies during that term. It does not accumulate any cash value. A is incorrect because term policies do not build cash value. B is incorrect because term life is temporary, not permanent. D is incorrect because term life insurance generally has lower premiums than whole life for the same death benefit. Question 24. Topic: Survivorship life insurance. Survivorship life insurance, also known as second-to-die life insurance, pays the death benefit: A. When the first insured dies. B. When the second insured dies. C. Upon the death of either insured, whichever occurs first. D. Immediately after the policy is purchased. Answer: B. When the second insured dies. Explanation: survivorship life insurance, also known as second-to-die insurance, only pays the death benefit after both insured individuals have passed away. This type of policy is often used for estate planning to provide funds for estate taxes or other expenses after both individuals' deaths. A and C are incorrect because the benefit is paid after the second death, not the first. D is incorrect because the benefit is not paid upon policy purchase. Question 25. Topic: Group life insurance. Which of the following is true about group life insurance? A. It is usually more expensive than individual life insurance. B. Coverage is generally based on the individual's health status. C. It typically provides term life insurance coverage for a group of people. D. Group members must always pay the full premium for the coverage. Answer: C. It typically provides term life insurance coverage for a group of people. Explanation: group life insurance is often provided as a benefit by employers or organizations and typically offers term life insurance coverage to a group of people. The coverage is usually standardized and may not require medical underwriting for each member. A is incorrect because group life insurance is generally less expensive. B is incorrect because individual health status may not be considered in group policies. D is incorrect because employers or organizations often subsidize premiums for group members. Question 26. Topic: Accidental death and dismemberment (AD) insurance. Which of the following is covered under an accidental death and dismemberment (AD) policy? A. Death due to illness. B. Loss of life resulting from an accident. C. Death resulting from natural causes. D. Medical expenses from an injury caused by an accident. Answer: B. Loss of life resulting from an accident. Explanation: accidental death and dismemberment (AD) insurance provides a benefit if the insured dies or suffers specific serious injuries, like loss of limbs or eyesight, due to an accident. It does not cover death due to illness or natural causes. A and C are incorrect because death due to illness or natural causes is not covered by AD. D is incorrect because AD policies usually do not cover medical expenses. Question 27. Topic: Universal life insurance. One of the main features of a universal life insurance policy is A. The premiums are fixed for the life of the policy. B. The policy does not allow policy loans. C. The cash value growth is linked to market investments. D. The premium payments and death benefit are flexible. Answer: D. The premium payments and death benefit are flexible. Explanation: universal life insurance provides flexibility in both premium payments and the death benefit. Policyholders can adjust these amounts as long as there is enough cash value to cover the cost of insurance. A is incorrect because universal life policies allow for flexible premiums. B is incorrect because universal life policies generally allow policy loans. C is incorrect because universal life policies have interest-based growth, not market-linked growth. Question 28. Topic: Beneficiary designations. Which of the following is true regarding the designation of beneficiaries on a life insurance policy? A. The beneficiary can only be a family member. B. A contingent beneficiary receives the benefit if the primary beneficiary is still alive. C. The policyholder can change beneficiaries at any time unless the beneficiary designation is irrevocable. D. A policy with multiple beneficiaries requires each to receive an equal share of the death benefit. Answer: C. The policyholder can change beneficiaries at any time unless the beneficiary designation is irrevocable. Explanation: the policyholder can typically change beneficiaries unless they have designated an irrevocable beneficiary, in which case the beneficiary's consent is needed for changes. A is incorrect because beneficiaries do not have to be family members. B is incorrect because a contingent beneficiary only receives the benefit if the primary beneficiary has passed away. D is incorrect because the death benefit can be divided in any proportion specified by the policyholder. Question 29. Topic: Accelerated Death Benefit Rider. What does an accelerated death benefit rider allow the policyholder to do? A. Cancel the policy before maturity and receive the full death benefit. B. Receive a portion of the death benefit while still alive under specific circumstances. C. Add additional coverage for accidental death. D. Decrease premium payments as the insured ages. Answer: B. Receive a portion of the death benefit while still alive under specific circumstances. Explanation: an accelerated death benefit rider allows the policyholder to access a portion of the death benefit if they are diagnosed with a terminal illness or meet certain criteria such as a severe medical condition. The remaining death benefit is paid out to beneficiaries upon death. A is incorrect because the death benefit is not paid in full before death. C is incorrect because this rider does not provide additional coverage for accidental death. D is incorrect because this rider does not affect premiums. Question 30. Topic: Settlement options. Which of the following is a common settlement option for a life insurance policy death benefit? A. Pay the death benefit in one lump sum. B. Use the death benefit to purchase health insurance for the beneficiary. C. Invest the death benefit in real estate. D. Require the beneficiary to take a loan against the death benefit. Answer: A. Pay the death benefit in one lump sum. Explanation: one of the most common settlement options for a life insurance death benefit is a lump sum payment where the entire benefit is paid to the beneficiary at once. Other options may include installment payments or leaving the money on deposit with the insurer to earn interest. B and C are incorrect because settlement options do not involve purchasing health insurance or investing in real estate. D is incorrect because beneficiaries are not required to take loans against the death benefit.